hope you've all had a bit of sugar to keep your energy levels up and ready for our final session of the day. I think as you look at the title of our next presentation, you'll see that it's fairly clear why it's in the program. It looks specifically at the crisis and at the next steps that the EU might follow. I know that some of you have heard Peter speak before. Welcome, Peter. Peter O'Shea is from Monash University, and again, you've got the note in the bio, but he's I guess that your formal link with Monash is as a PhD candidate, but Peter seems to be more than student in many ways. He's written two books published by Wiley Sons on financial markets and investment, and has worked as a managing editor for more than 10 years for a leading financial publishing company in the US. His research focuses on the drivers of ongoing European integration in the area of economic governance in the EU. It's with great pleasure that I introduce Peter and ask him to speak on the topic of the shape of the EU in the wake of the crisis.
Is this, so should I should probably use this. Can you hear down the back? Can you hear me down the back?
At the moment, yes.
At the moment.
With the microphone, okay, right, no worries. So essentially this is a topic that I've been following for quite a few years now. The Eurozone crisis in a nutshell, in a number of different aspects. But essentially what I was going to focus on today is basically now, 7 years, I suppose, after the global financial crisis started to evolve in Europe. Essentially how the EU has ended up, what does it look like today, and really what's sort of happened in the last 7 years to get where we are. So I'll just start with a little bit of background, just for people who may, well, it's just good to refresh anyway, but essentially the financial crisis started with the crash, the housing crash in the United States, and there were a whole lot of really bad mortgages that were mixed in essentially with all these exotic sort of investment products that were basically proliferated throughout the world but mainly to banks and in the US and Europe. So essentially that just led to huge debts in the financial sector, and then the markets crashed and everybody found themselves in really deep trouble. And that led to a system of coordinated bailouts that were sort of run by the G20. The G8 was the previous incarnation, but the G20, they decided that it was, they would widen the G8 to the G20. So they coordinated a system of bailouts for banks in the US and in Europe, and also other parts of the world. And there were a number of other changes that came out of this sort of international gathering of major economies that were affected by the crisis. They set up new global regulatory bodies, and obviously they realised that there were a lot of shortcomings in the financial sector, particularly in respect to regulation, because lack of regulation was seen as one of the problems that allowed some of these bad debts to happen or to accrue in the first place without anybody noticing. So that really then led to a whole range of reforms in the EU. But I think it sort of really has to be emphasised that there was really three phases of the crisis. Well, there's three crises, really. They're quite separate. The first one, as I said, was the mortgages issue, which spread to the financial institutions because they were the ones that had all the bad debts. But then, of course, they needed to be bailed out. Somebody had to help them. The only people in the position to help them out, the biggest financial institutions in the world, of course, were governments. So really that led to the sovereign debt crisis. So it's really the shifting of debt from one area to another. So that's essentially how it's evolved, and accordingly there's been a whole lot of reforms around those areas. There's been a lot of reforms around fixing financial institutions and regulating what they do and regulating some of the, these derivatives and some of the sort of more exotic type investment areas, and also coordinating the regulatory activity within Europe. So that's been fixed up. And then as the member states in Europe, talking about the EU, became particularly plagued with their own problems, there's been since this whole series of reforms around coordinating economic governance in the EU. So essentially, broadly there's three categories then of how things have been fixed up since the EU. So the first, as I said, is the regulatory reforms. So essentially, for example, all the member states in Europe had their own regulatory systems, and all their financial markets were all supervised by themselves, essentially. And they got together and shared information, and really that's about all they were doing, sort of on a committee type level. And that's really sort of all that was happening. But since the crisis, they've set up new sort of financial regulatory bodies in Europe. There's one called the European Banking Authority, which is based in London. There's the European Securities Authority, which is based in Paris. And there's another one that deals with supervising the occupational pensions and insurance areas. So essentially you've got supervision moving from the member state areas up to the European level. And the other area that's really been strengthened quite significantly is fiscal coordination. So coordinating all the different member state activities. Still all the member states are responsible for raising their own taxes and technically spending all their own money, and including getting themselves into debt. If Bulgaria wants to go and borrow money, it can borrow money. It doesn't have to ask anybody, or didn't have to. But essentially under this new treaty that was established, I won't read out the names, you can see it quite long and involved, but essentially what happens now is the member states come up with, this is what we plan to spend over the next 12 months, this is what we intend to borrow, this is the tax that we're expecting to get, etc. And all of this, these sort of budget plans, I suppose, are submitted to the European Commission, which then reviews them. And they've got different committee structures to look at these things, and the committee structures are composed of members of member states. It's all quite complicated, but essentially there's this kind of peer review process now that goes on. And the European Commission actually has the authority to veto the member state budgets. So it can say, it's effectively the same as, if Australia was a member of the EU, it would be like saying to the government, no, sorry, you can't spend your money on that area, or no, sorry, you can't borrow that money because that violates the treaty arrangement. So it's quite a significant loss of power, or transfer of sovereignty, really would be the technical term, in that area to Brussels. So there has been a much tighter reign over what governments are doing. I think the ambassador before referred to the Stability and Growth Pact, which was a pact that was agreed many years ago, where governments agreed not to spend too much, and they agreed not to borrow too much. But of course, as he said, that's been violated over the years, and there just hasn't been the sort of peer discipline within the EU to stick to that agreement. So that this type of arrangement is much more, it's designed to have a much tighter control over what is sort of spent. And then of course the third sort of area that's really changed is this whole idea of financial stability and loan assistance. And the ambassador also referred to the establishment of the European Stability Mechanism, which is based in Luxembourg, which basically never existed before. There's nothing like it. So it's essentially a mechanism that helps out member states in financial trouble. So that's quite a sort of a significant change. And these are just some of the details of those different areas, which I won't get into, because I'll sort of cover them to some degree. But essentially what's, I'll talk now about a little bit about how the EU has ended up. And one of the big changes is that there is really quite divergent growth patterns in the EU. And one of the things that you'll note, which is kind of not new to anybody, is that the southern states, Mediterranean states have got really negative or poor growth, and the Eastern European ones have got quite strong growth, which is quite interesting. It has really interesting long-term effects as well as short-term effects, which we're going to talk about, some of which are quite evident. But the main culprit, I suppose, or one of the culprits, probably not fair to say the main one, but one of the big culprits for the divergent growth patterns is the level of government debt. So you have to excuse me if I'm sort of covering things that everybody sort of knows, but I'm just not sure, how much everybody understands about the whole Eurozone issues or the crisis. But essentially, the debt-laden countries are those ones at the top: Greece, which we've obviously talked about today, Italy, Portugal, Ireland. Other countries as well, such as France and the UK, big economies, they've also got their share of problems. Debt's not necessarily a problem. For example, anybody in this room could go out and borrow $10 million if you had the capacity to pay that. It's not necessarily a problem. So some of these other countries, like heavily indebted, France, the UK, fortunately their economies are reasonably buoyant in comparison to countries like Greece and Italy, where their indebtedness is just too cumbersome to be offset by their economic growth. So that's really sort of the major culprit, and the tragedy is that to get yourself out of debt, you need to be generating revenue to pay it off. And for countries like Greece, where their government debt to GDP ratio is quite high, the prospect of paying it off in the near term, or turning their economies around, turning this situation around, is quite daunting. And that is leading to other changes. Obviously, we've talked about austerity today as well. But you can see in this graph, for example, that the burden of austerity is greater in some countries than in others. So in other words, Greece, I think what you can read from this is that Greek households are hurting a lot more than, for example, Irish households. And some of that relates to the way that the austerity packages are worked out. Essentially, it really is quite it has profound implications for families, and that leads on to other problems as well, such as unemployment. We've also talked about this today, but as you can see, Greece's unemployment rate is heading towards 30%, which is what I think in comparison, unemployment in Australia during the Great Depression was about 20%. Maybe some historians will provide a more accurate figure, but so that really is quite a significant number. And once again, it sort of raises the question, how can you get out of debt when you don't have enough people in the economy or in society working to generate money to help get out of debt? So it really is becoming quite it really is this vicious cycle that really is looking very difficult to get out of for a lot of countries. Situation's a lot better for some of these other countries, Germany, Luxembourg, Germany, Austria. And the implications of this picture is leading to other changes in the EU, other ways that the EU is And one of those is the issue of migration. Now, essentially, the darker bits, I'm the legend over there, but essentially the darker bits is net migration. So there are more people, like in France, for example, you've got some lighter areas around Paris and the heavily urbanised north. More people are moving to the rural areas within France. There's also net migration to the UK. A lot of that, which I know we're going to touch on after this, and I briefly mentioned a couple of slides, but a lot of that is intra-EU migration. And there is a perception, which is based in some fact, that a lot of people are moving from the poorer eastern countries to the wealthier western countries, and that's leading to a whole lot of animosity, etc., within Europe. But as we just sort of talked about, the economies in some of the eastern areas are actually doing quite well. So it's not necessarily entirely based on economic reasons. So it really, you do have to be careful in terms of drawing causal links. You know, this picture is illustrative of the global financial crisis. It's not necessarily the case, but you know, it is what it is. And indeed, you know, you also look at Italy, which has suffered quite badly, but a lot of people are moving to Italy. But there are countries such as Spain and particularly Ireland, Ireland is something that I think a lot of Australians can kind of understand. I mean, I guess most people have sort of gone into restaurants and realised how many Irish people there are, you know, serving in restaurants these days. So there are a lot of Irish. There is a lot more Irish coming to Australia. So this is one of the significant outcomes. Interestingly, just talking about the caution that needs to be exercised in coming up with conclusions about those migration patterns. If you look at, for example, the UK, there's a lot of animosity in the UK towards Bulgarian and Romanian immigrants, and there has been for a long time. There's been a lot of, because obviously you will be aware that under the Schengen Agreement, part of the European framework, it's outside the EU system, but part of the Schengen Agreement is and also part of the EU is free movement of people and workers. So essentially people from the eastern countries can now move to other parts of Europe and settle and live. They still need to have working permits, but essentially, you know, there's been a huge influx over the last decade, and even before that, of people from Eastern Europe. So these figures from the British Office for National Statistics show that actually most new migrants coming to the UK are actually from China. But nevertheless, there is some net inflows from other EU countries that have really suffered badly from the crisis, including Spain. For example, there was 27,000 Spanish moved to the UK in the 12 months to June 2013, which I know was 10,000 more than it was 12 months previous. And the other top 5 areas, just incidentally, where there's migration to the UK so China, other EU countries, Australia, the US, and Poland. I think the 5 areas in those figures that I looked at. But also at the same time, there's low levels of UK immigration abroad. And some of the results of this has been political resistance to the whole principle of freedom of movement of people. For example, in the UK, they've put caps on immigration from outside the UK. The Danish government, I think it was about a year ago, it might have been a bit more, put some limited restrictions on border movements, which is kind of unhindered movement within the EU is kind of one of the holy grails of the European Union. So when the Danish government sort of had limited border checks and passport checks, it created a huge stir within the EU. But nevertheless, this is the sort of thing that started to happen. There's also, for example, Spain and France have included some restrictions on the Romani moving into their respective countries. So all of this has sort of coincided with this rise of anti-EU sentiment. Excuse the crude image there, but I think it's really important this is an image that was actually, I took myself when I was in Athens. It was the day after the Greek elections. And this was the magazine cover that had come out, which is interesting because it really shows, I mean, that's a picture of Angela Merkel there, not Brussels. It wasn't the Barroso is the head of the president of the EU Commission. It was Germany. So there's this real anti-German sentiment, for example, in Greece, and also Spain, and Portugal, and Italy as well, because they perceive, rightly so, that Germany is the most dominant player in the EU, both financially and politically. There's absolutely no doubt about it. And the German and the French alliance has really arguably driven the whole EU project from the inception. So there's this rise of anti-German sentiment, and at the same time there's this real hostility in Germany as well towards some of the other countries that some Germans perceive that they are helping, bailing out. There's this perception that some of the people in the southern states don't work hard enough. They take their pensions too early. So there's sort of these tensions, hostilities rising on both sides. And it's been quite well documented that there has been a surge in popularity for some of the anti-EU political parties. This has been evident in French elections and German, for example. But also there's this trend, I think it's a bit of a global trend, I think you can say, but there's this really distinct anti-globalisation, anti-elite, anti-Brussels sort of sentiment that's quite pervasive in Europe as well. So that's the cultural aspect. Politically, there's also been some quite significant changes as well. So everybody be aware that there's 27 members of the EU, 27 member states, but not all of them use the euro. There's 18, I think there's 19 members. Latvia just joined the euro. So essentially, because a lot of the economic problems, or a lot of the problems, economic and financial actually, have related to the euro currency itself, as the ambassador explained, when your economy starts to contract, one of the options that you have is to devaluate your currency. But when you share a currency with a whole bunch of other countries, 17 or 18 other countries, that option's not available to you. So essentially, you're stuck in that one boat. So essentially, a lot of the problems that have related to that fact that there is a common currency, has meant that there have been a whole lot of reforms and issues and attention given to reforming just the Eurozone, the way the Eurozone functions. And the Eurogroup is a group of ministers from all of the Eurozone countries, the finance ministers. And really, it's become quite preeminent in a lot of the decision making in the EU generally. So, for example, the Eurogroup meets the day before an EU summit. So if there's an EU summit out there where all the heads of states come around and together and decide to reform different areas, or whether they're looking at new legislation that's come through, Eurogroup meets basically the day before and comes to their own decision. So it's really become quite an important political decision-making body. And also prior to the crisis, the European Central Bank, the ECB, really was restricted to just dealing with inflation. But essentially, as the crisis moved on, it was quite clear that all of the measures that the EU policymakers could come up with to tackle the crisis weren't enough. So I think everybody sort of pretty much noticed a bit of a change last year. The sort of tone of the crisis, you know, Greece is going to default any day, you know, it's all, the sky is falling, the sky is falling. That really died out in last year. And that was the moment that, the reason for that is because that was the time when the European Central Bank started buying bonds. So before that it hadn't done so to, on the sort of scale that it has since. Essentially what it is doing now is it's buying the bonds of some of the troubled countries, which has considerably eased their debt burden, so that's really freed up their cash flow. So essentially the ECB has become much, or the bank, the European Central Bank has become much more important as a player in the EU. That's pretty much it actually. I've got, I think, 20 minutes. So I think the only other thing that I would sort of question is whether all this means EU integration is on hold, and I suppose the conclusion, because of course the EU has been in this process of integration since the Second World War, and I suppose the conclusion that I would suggest is that yes, it is on hold socially. There's a lot more tensions on a lot more different areas than there have been, but politically, which is the interesting thing, as I talked about, there's closer regulation of financial markets, there's closer coordination of fiscal activity. So in Brussels they're integrating politically, but socially there really is there's this real tension there, and I think Ben probably going to highlight all of those a lot better than I can.